Buying a Strangle costs significantly less than a Straddle, but here is the catch. It often requires the stock to move 50% further just to break even. When you know a stock is about to explode, but you don't know which direction, you turn to volatility strategies. The two titans of this arena are the long Straddle and the long Strangle. Let's define the Straddle first. This is an at-the-money strategy. You buy a call and a put at the exact same strike price, usually where the stock is currently trading. The Strangle is the Straddle's cheaper cousin. You still buy a call and a put, but you push them out of the money. You buy a call above the current price and a put below it. Because you are buying options with no intrinsic value, the Strangle is significantly cheaper upfront. This lower capital requirement is why many new traders instinctively choose it. However, upfront cost is deceptive. To understand why, we have to look at the break-even points. This is where the math reveals the trade-off between price and probability. For a Straddle, your break-even is simple. It is the strike price plus or minus the total premium paid. Since you start at the money, every dollar the stock moves counts towards profit immediately. The Strangle makes you work harder. The stock must first travel to your strike price, and then travel further to cover the cost of the premiums. The gap to profitability is much wider. This creates a crucial decision point. The Straddle has a higher probability of profit, pop, because the stock has less distance to travel. You pay more for a mathematically easier win. Conversely, the Strangle is a pure leverage play. If the stock makes a massive 3 standard deviation move, the Strangle yields a higher return on invested capital because your denominator, the cost, was so low. But you must respect theta, or time decay. Both strategies suffer from it, but the Straddle is more resilient. At-the-money options decay slower than out-of-the-money options initially. Let's discuss the market environment. You should never buy either of these when implied volatility is already at historical highs. You are buying expensive insurance, hoping it gets more expensive. Ideally, you enter these trades when volatility is low, but you expect a catalyst. This allows you to profit from both the stock movement, delta, and the increase in volatility, vega. So, when do you choose the Straddle? Use it when you believe the move is imminent and you want to minimize the directional risk. You are paying for the luxury of not needing a specific target price. Choose the Strangle when you have a smaller budget or you are betting on a black swan type event. It is a lottery ticket structure, low probability, massive potential payout. Here is a common trap, legging in. Do not try to buy the call first, wait for a pop, and then buy the put. You are exposing yourself to directional risk, defeating the purpose of the strategy. Another major trap is holding through earnings. This is called the IV crush. Even if the stock moves, if the drop in volatility is severe enough, it will suck the value out of your premiums. To decide, look at the expected move priced into the market. If you think the stock will move less than the market expects, avoid both. If more, you have a green light. Here is your decision matrix. If you want higher probability and have capital, go Straddle. If you want higher ROI leverage and can accept lower win rates, go Strangle. Management is key. A good rule of thumb is to close these trades at 25% to 50% profit. Volatility mean reverts quickly. Do not get greedy waiting for a home run. Ultimately, the Straddle is the professional's choice for capturing movement, while the Strangle is a tactical tool for aggressive speculation. Know which game you are playing. Remember, buying options is a negative theta game. You are fighting the clock. Be right on direction or be right on magnitude, but above all, be fast. Choose the Straddle for probability, the Strangle for leverage.